But backwardation in both gold and silver is flippin' scary for LBMA or the COMEX or any entity that must deliver out that physical gold and silver, because it's very, very hard to come by the physical market, especially in the US, which is primarily a paper contract market. Don't be fooled. Take advantage of it, but don't be fooled, because
Okay, let's cut right to it. Something huge, truly unprecedented, just happened in the silver market. And gold, too.
Yeah.
Forget rumors. This is structural. Decades in the making. The paper system built to control these metals, it's cracking wide open.
It really is. And that's exactly the stark warning we're digging into today. We're looking at recent analysis from Lynette Zang.
Right.
And she's saying quite clearly that the moment she's predicted for years, that final melt-up phase, the big acceleration before a full monetary reset, well, it's actually started.
So this isn't just market noise.
No, not at all. What we're seeing, especially in the futures market, it's more than just volatility. It's like a fundamental breakdown. Trust is evaporating between the physical metal and the paper promises.
And the really shocking claim here, for the first time in, decades?
Generations, yeah.
The paper mechanism, the thing designed to keep prices in check, it's actually losing its grip on the real physical stuff.
Yeah.
The old rules just aren't working anymore. It feels different.
Absolutely unprecedented.
Okay. Before we get into why the big exchanges are reportedly scared stiff by all this, if this kind of analysis, looking ahead at these big monetary shifts, is valuable to you, please pause for a second and join our community over at CredEdge. Do it right now. You won't want to miss what's coming. All right, let's zero in on the smoking gun here. This signal, backwardation. It sounds technical, maybe a bit boring.
Yeah, it does.
But Zang calls it flippin' scary for places like the COMEX and LBMA. So what is backwardation, really, and why is it such a crisis signal?
Right. So backwardation, fundamentally, it screams shortage. Okay. In a normal, healthy market, if you want a commodity delivered in the future, say silver in 3 months, you'd expect to pay a little bit more than the price for immediate delivery, the spot price.
Yeah, that makes sense. Storage costs, interest, the usual, that's contango.
Exactly. It's contango. Standard time value of money, like you said.
Yeah.
But when you flip that on its head, when the current spot price is higher than the price for future delivery, that's backwardation. And it's happening right now in both gold and silver. It's the market shouting, essentially, forget your future promises. We don't trust them. Give us the physical metal right here, right now.
Okay, I get the signal, but why is that specific condition so terrifying for the exchanges themselves, the ones running the show?
Well, because the big markets, like in the US and London, they're primarily paper markets. They are structured, fundamentally designed to settle contracts in cash. They want to avoid physical delivery almost at all costs.
Because they don't actually have all the metal.
Precisely. Zang hammers this point. The leverage is just insane. Look, estimates vary, but people talk about maybe hundreds, perhaps even thousands of ounces of paper claims existing for every single ounce of actual physical gold or silver sitting in the registered vaults.
Wow. So if this backwardation forces people to actually demand delivery?
They run out instantly. The vaults would be empty. And, to really grasp how serious this is, Zang points to history. She says analysts are calling this the deepest, most sustained disconnect between paper promises and physical reality since 1980.
1980, that rings a bell. The Hunt brothers.
Exactly. 1980 was the Hunt brothers trying to corner the silver market. They weren't just trading paper. They started demanding delivery of huge amounts of physical silver against their contracts.
And the exchanges?
They panicked. They literally changed the rules in the middle of the game. They brought in Silver Thursday, forced liquidation, basically crashed the price to save the system from collapsing because they couldn't deliver the metal.
So when Zang says this is the worst since 1980, she's implying they might have to pull similar desperate measures again.
That's the implicit warning, yes, that they might be forced into rule changes because the physical obligation is becoming impossible to meet. It suggests confidence isn't just shaky, it's potentially collapsing under the weight of physical demand.
Okay, that paints a much more urgent picture. It's less like market swings and more like, well, the foundation's trembling. So if the exchanges know they can't deliver, and Zang says the physical metal is running short, how does she square that with spot prices that, sometimes look lower? Where's the evidence the metal is actually disappearing?
Right. This is where she talks about the emperor has no clothes situation. and what she calls the deception. She argues the exchanges are deep into perception management mode now.
Meaning?
Meaning they do things like maybe break up big contracts into smaller ones, like those 5,000-ounce silver contracts you hear about. It makes it look like there's more participation, more liquidity. But she calls these just trading products. They're designed to maintain the illusion, to keep the game going, while masking the reality that the actual physical vaults are draining.
Okay, but is there specific evidence of that draining? Where's the metal going if it's not showing up in higher prices consistently?
Yeah, good question. Zang points directly at the big ETFs, specifically the institutional holdings within funds like SLV for silver and GLD for gold. She's seeing massive coordinated outflows.
Outflows from ETFs, doesn't that usually mean selling, people getting out?
That's what it looks like on the surface. But Zhang says this isn't just retail investors selling their shares.
Yeah.
We're talking billions of dollars worth of physical metal being quietly pulled out, redeemed by large institutional players.
Okay, but I'm still a bit fuzzy on the price impact. If big institutions redeem ETF shares, the fund has to sell the underlying metal to pay them, right? Shouldn't that push the spot price down?
But that's the clever part. The calculated deception, according to Zhang.
Yeah.
When these big players redeem shares for the physical metal itself, not for cash, the immediate market action might temporarily push the visible spot price down.
Okay.
So retail investors see that dip, they think, oh, demand must be falling. Maybe they panic sell too, pushing the price down even further. But Zhang argues that metal isn't actually being sold back into the open market. It's being taken out of the system entirely, secured by institutions, going into private vaults, maybe leaving the country permanently.
So what looks like weak demand is actually a physical exodus, institutional hoarding disguised as a price drop.
Exactly. It's a really powerful idea. And it ties straight back to backwardation, you see. Why would these big players pay a premium now for spot delivery, which is what backwardation implies?
Because they want the real thing, not the paper promise. They don't trust the paper price anyway.
Precisely. They prioritize getting the physical asset with zero counterparty risk
Yeah.
over playing games with a temporary, potentially manipulated paper price. They want the metal in hand.
It's critical stuff for anyone trying to figure out wealth preservation right now. If you're finding this breakdown valuable, if you need this kind of context, please take just a moment right now to subscribe to CredEdge. We make sure you get this level of specific insight in all our analyses. Okay, let's pivot smoothly here. We've talked about the institutions grabbing physical metal. Let's look at the charts, the technicals. Zhang says we're entering a definite melt-up phase. What's the data showing that points to this final acceleration before things snap?
Right. The key technical indicator she focuses on is the 200-day moving average, the 200 DMA. Think of it like the long-term average price, like a center of gravity for the price. Prices might stray away from it, but they usually tend to want to come back to that line eventually.
So if the price gets too far above or below the 200 DMA, you expect it to correct back?
That's the general tendency, yes. And Zhang highlights that right now we are seeing an extreme stretch. Spot silver, for instance, is running something like 22% above its 200-day moving average.
22%? Is that a lot?
It's huge. Zhang notes that historically, even being 10% away from the 200 DMA is considered pretty stretched, pretty significant, so running 22% above. That signals really extreme, almost euphoric market behavior. It's a classic sign, she says, of being in that melt-up zone.
The final, maybe irrational surge higher before a major break?
Exactly. That stretched distance confirms the acceleration is happening. Now, we need to address those specific price numbers mentioned in the source material. Gold around $4,035, silver near $48.87. These are way higher than current spot prices we see flashing on screens.
Yeah, I was wondering about that. Are those like her predictions?
Yeah.
Or actual trades somewhere?
She frames them more as the technical and fundamental target prices. The kind of levels the market should be at based on underlying stress and value, the levels the paper market is fighting desperately to suppress. They represent the kind of euphoric spike she expects to see during this final melt-up phase, just before the system potentially fails or resets.
Ah, okay. So they're not real prices yet, but indicators of the pressure building up.
Precisely. She constantly reminds us, the paper price you see is an instrument of perception management. The technical structure, like being 22% above the 200 DMA, that's revealing the real underlying stress that points towards those much higher theoretical melt-up figures.
So for someone looking at this now, that huge stretch above the average, it presents both an opportunity and a risk, doesn't it?
That's the critical nuance, yes.
Yeah.
Because the price is so stretched, a correction back towards that 200 DMA is actually quite likely in the short term. It's overbought. But, and this is key, because the underlying trend, shown by both the 50-day and the 200-day moving averages themselves, is firmly upward, Zhang sees any dip back towards that 200 DMA not as a reason to panic, but as a potential buying opportunity.
An opportunity to get physical metal cheaper before the next leg up.
Knowing that the larger structural breakdown she anticipates will likely push prices far, far higher eventually. So, short-term correction? Maybe, but long-term trajectory is seen as strongly up.
Okay, let's bring this all back home to the individual. If the paper game really is failing, if these signals are accurate, what's the ultimate hedge? What does Zhang champion as the strategy? What's this zero-risk wealth actually look like?
It's almost defiantly simple, really.
Yeah.
It boils down to one thing: physical possession, holding physical gold and silver in your own hands under your control.
Why is that the core?
Because it carries zero counterparty risk. Think about it. If you hold the metal yourself, no exchange failure, no bank collapse, no broker going buzz can take it away from you. It's outside the system.
Okay, makes sense.
And second, it runs zero inflation risk. Governments can print trillions of dollars or euros or yen. They can create digital currency out of thin air. They cannot print gold. They cannot print silver. Its quantity is finite. It can't be inflated away like fiat currency or digital wealth held inside the financial system.
So it's real insurance. But Zhang seems to put a special emphasis on silver, calling it the barterable position. Why silver specifically over gold in that context?
Well, gold is fantastic. It's the ultimate reserve asset, the store of wealth. But silver is different. It's heavily consumed industrially. I mean, it's essential in almost every single sector of the global economy: solar panels, EVs, electronics, semiconductors, defense tech, you name it.
So there's guaranteed real-world demand.
Guaranteed functionality and demand, yes. But also, crucially, silver is much more affordable per ounce than gold. It's easily divisible into smaller, recognizable units, think small rounds, junk silver coins. This makes it uniquely practical for potential barter, for everyday transactions if, say, the digital payment systems go down or trust in fiat currency evaporates completely.
So gold for wealth preservation, silver for potential day-to-day use if things get really rocky.
That's a good way to put it, hence her advice, which is very direct. Focus on weight over shine. Meaning, don't get caught up in fancy collectible coins, numismatics, unless that's purely a hobby for you. For wealth preservation and potential barter during a reset, you want maximum weight of metal for your money. Simple bars, simple rounds, variety sizes maybe, for flexibility. But it's about the ounces, the grams, the tangibility. Don't get distracted by the paper price volatility day to day. Hold what's real.
Wow. Okay, this has been an incredibly focused look at some pretty alarming signals coming out of the precious metals markets. We've really pulled together Zhang's analysis here. Backwardation screaming shortage. The big money quietly pulling physical metal out of ETFs.
Yeah, the institutional exodus.
And the technical chart showing this extreme meltup zone stretch.
It really paints a picture of a system under immense stress.
The core conflict seems so clear now. It's trust in paper promises versus trust in physical reality. That's the battleground.
And the huge question is, can the paper system magicians pull another rabbit out of the hat? Can they change the rules again, force things back to their averages? Or are we actually seeing the start of a permanent break? A moment where trust in promises finally dies, and only what you can physically hold matters. That's the question of the decade, isn't it?
It really is. And Zhang leaves us with one final, pretty mind-bending thought to chew on.
Yeah.
She suggests that once this paper suppression game finally breaks completely, once silver's true monetary value gets measured against, say, the total global money supply and its actual purchasing power, she predicts it could eventually reach something like $2,000 an ounce.
$2,000. That certainly puts today's prices and volatility into perspective, doesn't it?
Makes this seem almost trivial.
Yeah. Look, whether that specific number happens or not, the framework is powerful. It's about understanding the potential disconnect between the paper price and the fundamental value in a crisis. It helps you position for reality, not just the flickering illusion on a trading screen.
Absolutely. We hope this analysis gives you a solid framework for your own thinking, your own preparation. If you want to keep getting this kind of targeted, in-depth analysis, make sure you are subscribed to the Credit Edge community. We'll catch you on the next one.